Hereby, New Vision Wealth Management says the U.S. dollar could lose up to, listen to this, 40% of its value over the next 3 years. More market insights next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Asian stocks and U.S. equity futures are higher on expectations President Trump is on track to ease the impact of his auto tariffs, boosting hopes for further dialing down of trade tensions. Joining us now is Ryan Lamond, Neo Vision Wealth CEO and co-founder. Really good to have you on the show, Ryan.
Thank you.
It has been, well, quite a volatile couple of months, but I would say just looking at the price action the last couple of days, investors seem to think that maybe the worst is behind us and that going forwards we could start to see more of a de-escalatory tone coming through from the Trump administration. What is your view?
Well, I hope so, because we've had a relief rally before, a few days back or a few weeks back. I have trouble believing that for now, because I don't see a real de-escalation. I will start talking de-escalation when I hear China answering back to the U.S. that, yes, we want to talk, we want to find a resolution for that. These things shouldn't be on the media.
Yeah. Okay, that's interesting, especially with some of the op-eds that are being written in Chinese dailies. So some people say that the damage has already been done to the perhaps more medium-term reputation of the United States, because we did see a shedding of U.S. assets, and it was quite pronounced a couple of weeks ago and actually prompted the Trump administration to come out with that 90-day reprieve. What is your view on that more structural shift and investors' inclination to stay away out of the U.S. in the next few years?
U.S. exceptionalism was based on the ability of the U.S. to issue debt in an unlimited way and do quantitative easing and boost their economy, spend, etc. This is what was attracting a lot of capital into the U.S. So it's the U.S. buying assets, sending dollars against them, and then these U.S. dollars finding their way back to the U.S. to invest into assets. The day President Trump gave an unsettled way of managing the U.S., second, attacking Jerome Powell, who is basically the safety trigger for the U.S. Monetary system, investors obviously lost interest in that market and even starting to feel fear. And that's why they went elsewhere where they have more stability. The only party that is holding the market together today are retail investors, basically, and the 10% richest Americans who control 93% of U.S. stocks. This is what's holding it together.
So he has dialed back his attacks on the Fed Chair Jerome Powell. So there's a bit of a U-turn there in that front. So you don't think that that's enough to reassure investors?
You know, the damage is there. So you slap someone on the face, right? And then you say, I'm sorry. The slap has taken place. And it was a big slap to Mr. Powell.
All right, let's talk about slapping the USD then. You have a pretty bearish view of the USD. It's definitely struggled in the first couple of months of this year. Your view is that we are set to continue to see further weakness in the dollar. How much more to run?
So as long as the current parameters are in place, yes, weakness of the U.S. dollar in general against main currencies, CHF, Japanese yen, euro, etc., but mainly also against the gold, because when gold prices go up, it's not the actual price of gold that goes up, it's the U.S. dollar that is weakening in cycle. That's how we see it. So as long as we're in that setup that we are in today, yes, we should see U.S. dollar. This is beneficial to the U.S. ultimately.
Yeah, well, yes, assuming that there are customers outside who want to buy U.S. manufactured goods. But let's just hold that thought for a second. Gold. Ever since I've been interviewing you, and I've been here, a year now, you've been bullish gold. It's had a tremendous run, but it started to come off. Do you think the gold trade is over? Would you still, if somebody hasn't bought gold yet, would you still buy at these levels?
As long as we're in exactly the same parameters we are in right now, yes, we would buy gold. The current dip is a great opportunity to buy. And anyone who missed the gold rally can buy silver. It's a nice proxy, though storage is an issue.
Why didn't silver participate in the same rally as gold? Lots of people were talking about that ratio between the two, and it reached 2 standard deviations.
The biggest buyers are central banks. Central banks, they buy actual physical gold. Storing silver at the same amounts, you'd actually need cities to store that silver. So gold is much more practical for a central bank to buy and store underground. It's a storage question.
Yeah. Do you think, though, that silver is an opportunity to get long and get some exposure to safe havens then.
It is, but it will not have the same rally as gold because we don't have the driver, the same institutional driver that we had with gold, which is institutional, very large buying.
Yeah. You mentioned some of the other safe havens quite quickly now. You just rapidly went through them, but we're talking about the Swiss franc, the yen, even the euro to a certain extent. And I just wonder whether, again, that trade may also run its course, because when you think about the European trajectory, they do have a hit coming from tariffs. The growth profile isn't particularly positive, and maybe there was too much emphasis on this German fiscal package, albeit only one country within the Eurozone as a whole that has that fiscal firepower.
The main driver of European stocks going up have been the defense stocks, for obvious reasons that we know. If today the war in Russia and Ukraine is resolved, then this trade is gone. That's why I agree with you. The European trade is limited to a certain extent. That's why we tend more towards fixed income, just for stability. But otherwise, it's mainly Swiss stocks and Japanese stocks, because we do believe that the Japanese yen will go below 140, and that's a big benefit for holders of Japanese risk assets.
Yeah, Ryan, always good to chat to you. Thank you so much. That was Ryan Lamons, Neo Vision Wealth CEO and